It was early April 2020. Andrew was feeling frustrated. The feared and expected COVID pandemic had forced a shutdown across the globe. He had already spent a week at home, watching television and just spending time with his family. He could no longer be with his friends, work the whole day at office, and sitting at home, he was beginning to feel depressed and itching to do something challenging and rewarding. He had heard about the stock market, and decided it would be a good way to put his free and idle time to use. He had also heard that the stock market is risky and unpredictable. But he convinced himself, he will play it safe, and risk just a little money. He would venture into stocks with $500 he could easily afford to lose and see how it goes. If he made profits, well and good. And if he lost, he would write it off and be peaceful. He checked the several advertisements flashing all over the internet and chose a broker, who promised to open a trading account in as little as 2 hours and get him trading in a day. The broker also was giving free trading advice, tips and suggestions to profit from the stock market. He figured he had nothing to lose. Just $500. He was getting free advice from the experts, and several of his friends were already making money, sitting at home. And with the money he would make, he would enjoy holidays, buy that latest iPhone he so desired, get his daughter the dream laptop she so wanted. Sounded like a nice plan, and he was already feeling good about it. He could see himself using the new iPhone and showing off to his friends. He could feel the joy in his daughter's eyes when she would get the laptop. Andrew now figured he would watch the stocks and watch his broker's advice, watch the experts on television, and test everything before risking his hard-earned money. The first advice to buy an online retail company stock, as it was moving swiftly ahead. He checked the price. It was quoting $40 and he just decided to watch. He could easily buy 10 shares with his $500. He decided to watch. By the end of the day, the price had moved to $42 and if he had bought, he would make a profit of $20, doing nothing. Just buying the stock. The next day, the stock opened higher and was quoting a price of $46, a whopping 10% more than the previous day. By the end of the day, the stock was quoting at $48, and Andrew began regretting. He should have bought the stock as soon as he got the tip. He would be making a profit of $80. But he was also apprehensive. This is too good to be true. Then came another tip from his broker. To buy another automobile manufacturing company stock. It was now quoting higher at $110. He would be able to buy only 5 shares. Too small a quantity. So he figured, probably he would have to invest a little more than $500. He decided to risk a little more and decided to increase his investment to $1,000. This would give him more gain quickly, and he would be able to fulfill his dreams sooner. The third day, the online retailer stock was trading at $62 and Andrew was well and truly anguished, and deeply regretted not buying it. He would be making a $220 profit on a $400 investment. That was more than 50% gain in just 3 days. He was more anguished when he saw the automaker stock trading at $142. He could not believe his eyes. He would be making almost $400 in profits if he had acted on the broker's advice. Now Andrew was completely hooked. He decided to spend every moment of his day watching business news and trading. He was feeling super confident, and in a very short while, he too was going to make huge profits, like so many of his friends. He even began dreaming about the holiday he will take with his family after the lockdown was lifted. Andrew quickly transferred $1,000 to his trading account and decided he will begin his stock trading from the next day. He woke up early the next day, feeling extremely enthusiastic. He waited for the market to open and for tips from his broker. The market opened higher again and both the stocks were trading higher again. He figured, if he had acted on the advice, he would now be making over $600 in profits with his now $1,000 investment. The dream iPhone is now within his reach. Then came the tip from the broker. Buy FMCG company stock at $27. He decided to go small and not risk much. He bought 10 shares and waited. He was now watching the prices every moment. $27. $27.10. $27.40. $27.60. $27.95. $27.75. $28.10. His heart was beating fast. He could feel the excitement. With every price move higher, he was feeling happier. This is wonderful, he said to himself. I'm going to trade stocks and make a lot of money. This is so easy. The day ended with his FMCG stock trading at $31.30, and Andrew was elated. $43 in profits. He quickly calculated. 22 trading days every month, and at this rate, he would make almost $900 in a month. $900 he could spend as he wants. And now he was completely hooked. In the next few days, Andrew's joy knew no bounds. His trading yielded him fantastic results. He was now in profits of well over $1,200 on his $1,000 investment, and still had 6 more days to go before the month ended. But this was small compared to his dreams. He needed more than this to fulfill all his dreams. If he can make $1,200 with $1,000 in investments, he could easily afford to invest $5,000 and would be making $6,000 every month. At this rate, Andrew would not even need to work at his job. He can sit at home and trade stocks full-time and achieve all his dreams. He checked his bank account and transferred $10,000 to his trading account. He was now going big. He will make $20,000 in the next few weeks. By end July 2020, Andrew did make the profits he so wanted. He got his dream iPhone, his daughter Amelia got her dream laptop, and he was now sitting on a profit of over $4,000, after spending money on the phone and laptop. He had by now increased his investment to $25,000 to make more profits quicker. And then came September 2020. Markets started declining, and every day, Andrew's stock's value was going down. He had already spent most of the profits he made. His anguish knew no bounds. How can this be? He was doing everything the experts were saying. He was following all the tips given by his broker. He talked to his friends, and they too seemed to be in a similar boat. They told him to just be patient and wait. There is nothing wrong in the markets. They are bound to go up eventually. By October 2020, Andrew was totally depressed. It was 2 months now and his investment was down to $18,000. A near 28% loss. He had made a lot of profits, but had spent all the profits. He now only had losses to show for all his efforts of the last 6 months. He rued and regretted his decision to invest in the stock markets. He decided to cut his losses and exit from all his investments. He ended with a net loss of $7,000 in his trading activity. But then lo and behold, the very next day, stocks started moving higher. And by December, markets had regained the earlier high and were furiously moving higher. Had he held on to his stocks, Andrew would now be making more than $15,000 in profits. He would not only have recovered his losses, but also made a profit. Adding both the loss he made and the profits he could have made, Andrew would have been up by over $22,000. He was feeling furious with himself. No one but himself to blame. He decided then and there, he would now trade sensibly and will trade big. He transferred $50,000 into his trading account and began trading again with renewed vigor and enthusiasm. And thus, a stock trader is born. Does this sound familiar? Have you also been through such a journey? There is no reason why anyone cannot make a substantial amount of money in the financial markets, but there are many reasons why many people will not. As with most endeavors in life, the key to success is knowledge and action. This course will shed light on the internal workings of the markets, and help expand the knowledge, leading the action to patience, discipline and objectivity of the trader, and subsequently to consistent and well-earned profits. This course is for the beginner, for the intermediate trader and investor, and the expert alike. Starting from the very basics, we shall explore the different methods of approaching the markets, and address some of the advanced concepts, to lay a foundation for a deep understanding of the markets and profitable trading. May your trading never be the same again. Technical and fundamental analysis. Success in the financial markets demands a mastery and understanding of chart analysis. All market decisions are based, in some form or another, on a market forecast. For a long-term investor, or a short-term investor, or a day trader, price forecasting is the first and most important step in taking the decision to trade. To accomplish this, there are 2 methods available to the trader. 1. Fundamental analysis. 2. Chart analysis or technical analysis. Fundamental analysis is the traditional method of studying supply and demand, the basic factors that influence the rise and fall of the financial markets. The fundamental analyst looks at corporate earnings, change in money supply, interest rates, price of crude oil, trade deficits and the regulatory scenarios to estimate the value of a market. Based on this analysis and valuation, he determines if a market is underpriced, overpriced, or valued correctly, and takes a decision to invest, exit or stay away from the markets. Technical analysis, on the other hand, is based entirely on a study of the market action itself. The technical analyst studies the effects in the price chart itself. Charts can be used with or without any fundamental input. It can be complementary to fundamental analysis, or as has been proven in the last few decades, can stand alone without any fundamental input. The most important step in all investing is timing the markets. Timing is extremely important for the short-term trader, and even very small moves in the market can have a big impact on the performance of the short-term trader. Precise timing of the markets is essential for successful trading. Timing is everything for the short-term trader. While it plays a big role in the decision-making process of the long-term investor, timing can be critical to the results of the short-term trader. It will be seen quickly that timing is the only goal of technical analysis: to execute the right trade at the right time. What is technical analysis? Technical analysis is the study of market action using price charts to forecast future price action and direction. The basic premise is the belief and observation that all factors that influence market price and action are inherently factored in the price and price action. Technical analysis is an understanding of the symbolic language of the markets. As the market action encompasses all factors, these factors show in different patterns on the price chart. This is indeed the language of the charts, and can aid in successful trading and investing activity. Think about this. When demand exceeds supply, prices will increase, and when supply exceeds demand, prices will decline. These fundamentals reflect in price changes. This can be seen quite easily in the price chart. With the logic of rising prices and declining prices known, the technical analyst does not need to know what is causing the increased demand or increased supply. He can quickly profit from such an observation of price changes. It can also be observed that market price changes are usually seen even before the fundamental factors are known in the public domain. Market itself appears to have a premonition of the immediate future, and the technical analyst can profit immensely from such an observation. The basic elements of a price chart. Let us now understand the price chart. The price chart is primarily a graph with two axes. The x-axis represents price, and the y-axis represents time. In the present digital age, different price chart platforms show these two elements differently, and can be customized. The price scale can be shown on the right side of the chart, which is normal, and can also be shown on the left side. The y-axis represents a unit of time. This could be a minute, an hour, a day, a week, a month, or whatever time frame we want to use. It can also be set to represent 5 minutes, 15 minutes, 4 hours, 6 hours, etc. as we want to analyze. The price. The price of a stock traded on the exchange is constantly changing. Most markets across the world have fixed business hours, also called trading hours. For example, the New York Stock Exchange, NYSE, opens for trading at 9:30 a.m. and ends trading at 4 p.m., Monday to Friday. The National Stock Exchange of India, NSE, opens for trading at 9:15 a.m. and ends at 3:30 p.m. Every exchange has its own fixed trading hours. During trading hours, stocks are traded continuously. As trading continues, the prices are changing constantly all through the day. Every transaction on the exchange is recorded and the price is noted. Thus, when the exchange opens for trading, price of every stock is recorded. This is called the open price. As trading continues through the day, prices are recorded, and the highest prices at which the stock is traded is also recorded. This is called the high. Similarly, the lowest price a stock trades through the day also gets recorded, and this is called the low. The price is also recorded as the markets close for trading, and this value is called the close. Thus, in every trading session, we see 4 different values for every stock: the open price, the high price, the low price, and the closing price, commonly called OHLC. This is represented on the chart as bars. Every bar denotes 4 different values. Observe this bar here that we see on a chart. The small horizontal stub we see to the left of the vertical bar denotes the open price. The upper level of the vertical bar denotes the high price, the lower level of the vertical bar denotes the low price, and the small horizontal stub we see to the right of the vertical bar denotes the closing price. Thus, from every bar, we can immediately see the 4 important levels of every trading session. Open, high, low, and close. OHLC. There are many methods of plotting the price action, and we will look at them later, once we understand the basics of the charts. The line chart. While the bar chart represents all the 4 values of every trading session, the line charts sometimes yield some hidden information. We will look at the line chart as we go along the course and appreciate the subtle hidden messages of the markets. A common line chart simply connects each successive day's closing prices and is the simplest form of charting. Similarly, we can plot a line chart with high values, open values, and close values too. The bar color. With the usage of the digital chart and online charting platforms, much more information could be added to the charts readily. This visual aid helps us in gathering more information at a glance. Thus, by default, when close value is higher than the open value, the bar is colored green, and when the close value is lower than the open value, the bar is colored red. This is now a universally accepted coloring system. An important distinction needs to be made here. The price itself, and therefore the bar itself, can be higher than the previous day, but as long as the open is higher than the close, the bar will be colored red. Vice versa, irrespective of the value, as long as the close is higher than the open, the bar will be colored green. Sometimes, this presents a difficulty while reading the chart, and hence we should be aware and pay attention to these subtle bits of information being conveyed by the markets. The status line. The status line is the line of text shown here, at the top left-hand corner of the chart. This line can be modified to convey many bits of information instantly. Here, it is showing the name of the instrument plotted, Dow Jones Industrial Average, the time interval of the chart, 1 day, meaning every bar represents 1 day of trading action, and the open, high, low and close values. Many more bits of information can be shown on the status line, and we shall add them as we continue along this course. Plotting the daily chart. Plotting the chart is an extremely simple task. The first step in plotting a given day's price data is to locate the correct calendar day. This is accomplished simply by looking at the calendar dates along the bottom of the chart. Plot the high, low, and closing prices for the market. A vertical bar connects the high and low. The closing price is recorded with a horizontal stub to the right of the bar. The open price is recorded with a horizontal stub to the left of the bar. Each day, simply move 1 step to the right. Volume is recorded with a vertical bar along the bottom of the chart. Volume is the number of shares traded in the trading session. Trends. A glance at any price chart will quickly reveal that markets trend, and that trends tend to persist and continue. The trend is the current direction of the price. See the uptrend and downtrends here. In simple terms, an uptrend is when prices are moving higher, and a downtrend is when prices are moving lower. The most important value of price charts is that they reveal the trend and facilitate the study of these trends. Technical analysts use many techniques to identify trends and to determine the probable extent of the trends, and most importantly to identify as early as possible the change in trend direction. Trends can be divided into 3. 1. Simple trend. 2. Swing trend. 3. Complex trend. Simple trend. When we plot the daily chart, we can immediately see the trends of the market. Trends are the basic building blocks of the market. Every bar is akin to the letters of the alphabet. Just as the alphabets combine to form words, these bars combine to form the trends. A simple trend is a series of bars showing a trend. Thus, a simple uptrend is a series of bars with higher highs and higher lows. This uptrend continues till the previous bar's low is broken. See here how every successive bar posts a higher low and a higher high. A simple downtrend is a series of bars with lower highs and lower lows. This downtrend continues till the previous bar's high is broken. See here how every successive bar posts a lower high and a lower low. One major point here. In an uptrend, we need to pay most attention to the lows. And, in a downtrend, we need to pay attention to the highs. The reason becomes immediately apparent when we think a little deeper. The uptrend represents a period of increasing demand, and thus the price should keep rising higher and higher. The low represents the lowest price at which the demand surges. Thus, a higher low points to an increasing demand for that period. And likewise in a downtrend, we pay most attention to the highs. See this example chart here. And pay attention the simple uptrend. Every successive bar exhibits a higher low and a higher high. The very essence of a simple uptrend. The swing trend. These simple trends combine to form a swing trend. The units of the simple trend are the individual bars, and the units of the swing trend are the simple trends. Thus, in a swing uptrend, higher peaks and higher lows are formed by the simple trends. In a swing downtrend, we can see a lower highs and lower lows. The principle remains the same, higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. See this real market chart, and observe how the simple trends combine to form the swing trend. The complex trend. Just as the simple trends combine to form the swing trend, swing trends combine to form the complex trend. In a complex uptrend, every swing trend will exhibit a higher swing high and a higher swing low. And in a complex downtrend, every swing trend will exhibit a lower swing high and a lower swing low. It can also be said that a complex uptrend is a bull market and a complex downtrend is a bear market. Observe this chart here and note how within the swing trends, the simple trends are changing direction, and how the swing trends also exhibit the changing swing trends, while market remains in a broad complex trend down, with lower highs and lower lows. This complex downtrend can only be said to change the larger trend when the previous swing high is taken out. What is a trend? We can now define a trend. What is a trend? Trend is the broad direction of the market. An uptrend is a series of higher lows and higher highs. A downtrend is a series of lower highs and lower lows. Within the limits of observation, we need to define the three different kinds of trends differently. A simple uptrend is a series of bars with higher lows and higher highs on every bar. A simple downtrend is a series of bars with lower highs and lower lows on every successive bar. A swing uptrend is a series of simple trends with higher lows and higher highs on every successive simple trend. A swing downtrend is a series of simple trends with lower highs and lower lows on every successive simple trend. A complex uptrend is a series of swings with higher lows and higher highs on every successive swing. A complex downtrend is a series of swings with lower highs and lower lows on every successive swing. With this understanding, we can look up any chart and immediately ascertain the immediate trend, the intermediate trend, and the long-term trend. Support and resistance. A previous low usually forms a support level. Support is a level below the current market level, where previously, buying exceeded supply, and the prices reverse their trend. A previous high usually forms a resistance level. Resistance is a level above the current market level, where selling exceeded demand and prices reverse their trend. The more recent a support or resistance level has been formed, the more influence it exhibits on market action, because the trades that helped form the level may not be liquidated, and are more likely to influence the trading decisions. See this chart here, and observe the support and resistance levels. Role reversal. Once a support or resistance level is conclusively broken, it changes its role and assumes the characteristics of its counterpart. Thus, a resistance when conclusively broken becomes future support level, and a support once broken becomes future resistance level. Why is this important? If you recall, every price level that produced a previous high is an area of increased supply, and we called it a resistance. And every area that created a low is a zone of increased buying. We call it a support. So, unless market exhibits strength and takes out a previous high or resistance area, we can expect supply to exceed demand and the trend to decline. So as a rule, unless market exhibits a change in sentiment and takes out an area of earlier resistance or support, do not be in a hurry to call for a change in trend, as trends can persist for a long time. Trend lines. The trend line is the most valuable and also the simplest tool used in technical analysis. It is simply a straight line. An uptrend line is a straight line from left to right, connecting uptrend higher lows. An uptrend line is drawn simply by connective two lows, in such a way that all market action is above it. A downtrend line is drawn by simply connecting two lower highs, in such a way that all market action is below it. A trend line can be drawn when at least two rising lows are seen, or two declining highs are seen. However, simply drawing the trend line, connecting two higher lows or two lower highs, does not make it a valid trend line. As a rule, a third point retest is necessary for the trend line to be valid. This point is forgotten by most analysts, leading to erroneous trades and losses. Trend lines aid us in identification of support and resistance levels, and these levels can be used to initiate new positions when the markets are trending. A trend line that has been tested multiple times is more significant, and breaking such a trend line is a warning of a change in trend. Channels. Once a trend line is drawn, we can draw a channel line. Channel lines are straight lines that are drawn parallel to the basic trend lines. A rising channel line is drawn above the price action, and parallel to the rising trend line, in such a way that all price action is contained within the two lines. A declining channel line is drawn below the price action and parallel to the declining trend line, in such a way that all price action is contained within these two lines. Markets often trend between these two parallel lines or channels. When this happens, the analyst can know in advance where the resistance and support are likely to be seen. Price patterns. Markets move in patterns. Market price movements are essentially reflections of the sentiments of the trading and investing community. The presence of lasting and alternating trends points us to a rhythm of alternating optimism and pessimism. These rhythms produce patterns, and since these patterns repeat, they have a predictive value. This can be readily understood by a study of the patterns of the market. Patterns also reveal the ongoing struggle between supply and demand forces and allow the chartist to gauge which side is winning. Price patterns can be divided into two groups. 1. Reversal patterns, and 2. Continuation patterns. Reversal patterns indicate that a change in trend is taking place or about to change, while continuation patterns indicate a pause in the existing trend. Continuation patterns are quick to form than reversal patterns, and usually result in resumption of the original trend. Reversal patterns. Head and shoulders pattern. The most reliable and the best known reversal pattern is the head and shoulders. This can be seen at both market tops and bottoms. The typical head and shoulders top pattern consists of three prominent peaks. The middle peak or head, preceded and followed by two lower peaks, called shoulders, one on either side of the final rally. The line joining the two intermediate lows is called the neckline. The head and shoulders pattern is confirmed only when the neckline is broken by market price action. The vertical distance measured from the top of the head to the neckline, projected below the neckline, is the target for the decline. The inverted head and shoulder is seen at market bottoms. It is the head and shoulders pattern, flipped upside down. Double top or bottom. The double top consists of two prominent peaks separated by a low. The pattern is confirmed only when the low between the two similar peaks is broken and market trades below the low level. The target for the double top is once again the vertical distance from the peak to the low, projected below the low point. The double top flipped upside down is the double bottom. The double top is also called an M top, and the double bottom, a W bottom. Triple top or bottom. The triple top is a variation of the head and shoulders pattern. The only difference is that the three peaks or the three bottoms occur at roughly the same level. Triple tops and bottoms are interpreted the same way as the head and shoulders pattern. The levels are slightly different and mean essentially the same thing: reversal. Saucers and rounding top. The saucer pattern occurs at market bottoms, and a rounding top, as the name implies, develops at market peaks. The saucer is constructed by drawing a circular line under the lows, roughly exhibiting an elongated arc. This is also usually a period where investors and traders lose interest and all momentum disappears. Gradually both price and interest pick up, until eventually prices explode into a frenzy. The exact opposite of the saucer at market tops is the rounding top. The rounding top is constructed by drawing a circular line above the highs, roughly exhibiting an elongated arc. This once again is a period of dull activity, as the peak of the rounding top is reached and interest slowly picks up, and we see prices decline swiftly into a selling frenzy. Spike tops and bottoms. In a complete contrast to the rounding top and saucer bottom, the spike top and the spike bottom display a sudden change in trend. The distinguishing feature of the spike from other reversal patterns is the complete absence of a transition period. The sideways action, constituting a topping or a bottoming activity, is missing on the chart. This pattern marks a dramatic change in trend with little or no warning, and is usually seen when price has been moving rapidly in a parabolic fashion. Do not make this blunder. Quite often, traders observe the formation of patterns and anticipate a breakdown or breakout. This is a blunder. In chart analysis, the prevailing trend is assumed to be in force until evidence proves it reversed. Price continuation patterns. The reversal patterns are warnings and indication of trend reversals. Instead of warnings of market reversals, continuation patterns point us to a pause in the current trend, only to resolve further in the direction of the earlier trend. A thorough knowledge of the reversal and continuation patterns arms us with solutions to most of the trading problems faced in the markets. Triangles. The triangles are a reliable continuation pattern. There are three types of triangles. 1. The symmetrical triangle. 2. The ascending triangle, and 3. The descending triangle. While they sometimes appear at market tops and bottoms, meaning a trend change, they are commonly seen to appear at pauses in a trend. The symmetrical triangle is a sideways activity between two converging trend lines. The upper trend line is declining, and the lower trend lines is rising. The price action between the trend lines appears to get crushed or wound tighter and tighter like a coil, and price thrust out swiftly from this pattern, in the direction of the earlier trend. The ascending triangle has a flat upper trend line, and a rising lower trend line. The rising lower trend line represents that the buyers are more active, and absorbing more of the selling pressure. This pattern is usually a bullish pattern. The descending triangle is once again a sideways activity that shows a declining upper trend line and a flat lower trend line. This points us to the sellers being more aggressive than the buyers. This is usually a bearish pattern. The symmetrical triangle, while it unfolds, shows a balance between the buyers and the sellers. It is usually a pattern that resolves in a continuation of the earlier trend. The ascending and the descending triangle point to the impending resolution of the pattern. They usually resolve in the direction of the slanted trend line. Flags and pennants. The flag, as the name implies, appears like a flag. It is a quiet phase of the market after a long directional movement in price. The steep price move is called the pull. The flag itself is a brief pause or resting period for the market before the prior direction resumes. The flag resembles a parallelogram sloping against the trend. Flags also mark the midpoint of a trend. The pennant, similar to the flag, is akin to the symmetrical triangle, usually horizontal with both the upper and lower trend lines converging from left to right. Wedges. The wedges are similar to the triangles. However, the triangle shows two trend lines, one rising and one declining, or one horizontal and the other rising or declining. The wedges show two converging lines both moving in the same direction. A declining wedge shows a temporary interruption of a rising trend, and a rising wedge shows a temporary pause in a declining trend. Gaps. The gaps are areas on the chart where no trading activity has taken place. An upward gap occurs when the lowest price of a day is higher than the highest price of the previous day. A downward gap means that the highest price of a day is lower than the lowest price of the previous day. A gap is represented on the charts with empty vertical space between one trading day and the next. There are four kinds of gaps. 1. Common gap. 2. Breakaway gap. 3. Continuation gap or runaway gap. 4. Exhaustion gap. The last three types of gaps, the breakaway gap, the continuation gap and the exhaustion gap, have forecasting value. Being able to distinguish the different kinds of gaps can provide useful and profitable market insights. The continuation gap occurs within a trading range, while the markets are stuck between two broad levels, oscillating up and down. This gap has no practical value. It is to be ignored. The breakaway gap usually occurs after the completion of a price pattern. It is signaling a significant price movement ahead. A breakaway gap after a head and shoulders pattern, or a double top pattern, often is a breakaway gap. The runaway gap, or the continuation gap, is seen after a trend has been unfolding a while. It often appears around the halfway mark in the trend. The exhaustion gap occurs at the end of the market move, and signals a last gasp in the trend. The exhaustion gap is the only gap that gets filled quickly by the market action in the opposite direction in the next few time periods. During uptrends, the breakaway and runaway gaps usually provide support below the market on subsequent market dips, and during downtrends, these two gaps act as resistance above the market on bounces. The key reversal. The key reversal is a minor one-bar pattern that warns of an impending change in the short-term trend. In an uptrend, prices usually open higher than the high of the previous bar and break sharply to the downside, to close below the previous day's closing price, or even the previous day's low price, and in a downtrend, prices usually open lower than the low of the previous bar, and rally sharply to the upside, to close above the previous day's closing price, or even above the previous day's high price. The larger the range and the higher the volume of the key reversal bar, the more significant the warning. Outside bars, where the high and the low are both wider than the previous day's range, are considered very important. Key reversal days are not used by themselves and are to be used together with other technical indicators. Volume. The price patterns and prices are one dimension of the market. The other dimension is volume. Volume is the number of units of any asset traded in any given time period, usually one day. Volume can also be studied and monitored on weekly and monthly basis for longer range analysis. As seen before, volume is shown by vertical bars at the bottom of a price chart. The higher the volume, the longer the vertical bar, and vice versa. Volume usually accompanies the trend. Volume increases with trend of prices, and volume decreases when a counter trend is in place. This is the normal relationship. Any divergence from this normal is to be regarded as a warning sign that the current price trend may be in the process of reversing. Volume measures the strength behind each price movement. When used in conjunction with the price action, volume tells us about the strength or weakness of the current price trend. As a rule, heavier volume should be present in the direction of the prevailing price trend. During an uptrend, heavier volume should be seen during rallies, with lighter volume during downside corrections. In downtrends, the heavier volume should occur on price sell-offs. Bear market bounces should take place on a lighter volume. Volume also plays an important role in the formation and completion of price patterns. Each of the price patterns described previously has its own volume pattern. As a rule, volume tends to diminish as price patterns form. The subsequent breakout that resolves the pattern takes on added significance if the price breakout is accompanied by heavier volume. Heavier volume accompanying the breaking of trend lines or support and resistance levels lends greater weight to price activity. Technical indicators. The technical analyst primarily has 6 bits of data: open, high, low, close, volume, and date/time. Using this data, and making several mathematical calculations, the technical analyst can arrive at many conclusions. The results of these mathematical calculations can also be plotted on the price charts. Such plotted results on price charts are called technical indicators. Technical indicators can be broadly classified into 2 main categories. 1. Overlays. These are indicators plotted on the price chart itself, over the market price action. 2. Oscillators. These are indicators plotted in a separate section, below or above the market price action. The moving averages. Among the technical indicators, moving averages are extremely popular with market technicians, and with a good reason. The trends in stock prices can be extremely volatile and haphazard. One technique of dealing with this volatility is to smooth the price, using an average, called the moving average. A simple moving average is the most commonly used technical indicator. The moving average is constructed by totaling a set of data, and dividing the sum by the number of observations. The resulting number is known as the average, or mean average. Thus, if we take the close value of the last 5 trading sessions and add them up, and divide the sum by 5, we arrive at the 5-day, simple moving average of the close. We can thus calculate moving averages of the high, the low, the close, the open, and even a moving average of volume. The shorter the time periods used to calculate the moving average, the more sensitive it is to the fluctuations of the markets, and correspondingly, the longer the time periods, the more smoothed action we see on the moving average. Generally speaking, a rising moving average indicates market strength, and a declining one denotes weakness. It can also be readily seen that the moving averages also act as support and resistance zones. Price action generally tends to bounce off the moving averages, and once crossed over, the moving average can be seen to act as resistance and support respectively. A major point to remember, changes in the price trend are identified by price crossing the moving average, and not by a reversal in direction of the moving average. Envelopes. As the moving averages act as support or resistance, this idea was taken further by constructing symmetrical lines, parallel to the moving average called envelopes. It can be seen that stock prices fluctuate around a given trend in cyclical movements, in similar proportions. In other words, the moving average is the center of the trend, and the envelope consists of the points of maximum and minimum movements, away from the moving averages. This process can be further expanded to include more than one envelope. For example, if the moving average is at 500, the envelopes can be plotted at 400, 450, 500, 550 and 600. Bollinger Bands. A very interesting and useful envelope was devised by John Bollinger. In place of a fixed percentage above and below the moving average, envelopes are plotted 2 standard deviations above and below the 20-period moving average. When price action touches or exceeds one of the upper or lower envelopes, prices are said to be extended, and it is normally seen that prices will pull back to the moving average line. Oscillators. While the methods of trend determination like the trend line, price patterns, moving averages and envelopes are extremely useful, they identify a change in trend after it has taken place. The oscillator helps to measure market extremes and tell the chartist when a market advance or decline has become overextended, with the simple observation that an overextended market tends to revert to the mean quickly. These market extremes are called overbought and oversold market conditions, and should not be confused to mean any extraordinary buying or extraordinary selling literally. Such a condition does not exist in the market. Overbought and oversold simply mean that the markets are extreme distance from the mean. The oscillator is plotted on the bottom of the price chart and fluctuates within a horizontal band. When the oscillator line reaches the upper limit of the band, a market is said to be overbought and vulnerable to a short-term setback. When the oscillator is at the bottom of the range, the market is said to be oversold and probably due for a rally. As is the case with most technical indicators, these oscillators can be employed in any time frame. That means, they can be used on weekly, daily, and intraday charts. On digital charts, the time frames can be changed at the click of the mouse, and the oscillators will be seen to still be useful and readily aid analysis. The stochastic oscillator. This oscillator is also plotted on a scale from 0 to 100. The upper and lower lines, marking the overbought and oversold levels, are at the 80 and 20 levels. In other words, readings above 80 are overbought, while readings below 20 are oversold. One feature of stochastics is that there are 2 oscillator lines instead of 1. The slower line is usually a 3-day moving average of the faster line. Trading signals are given when the 2 lines cross. A buy signal is given when the faster line crosses above the slower line, from below 20. A sell signal is given when the faster line crosses beneath the slower line, from above 80. The time period used by most chart analysts is 14 days. The Relative Strength Index. This is one of the most popular oscillators used by technical traders. The RSI scale is plotted from 0 to 100, with horizontal lines drawn at the 70 and 30 levels. An RSI reading above 70 is considered to be overbought. An RSI reading below 30 is considered to be oversold. The most popular time periods for the RSI are 9 and 14 days. The principle of confirmation. The principle of confirmation holds that the more technical evidence supporting a given analysis, the stronger the conclusion becomes. In the study of an individual market, for example, all the technical signs should be pointing in the same direction. If some signs are pointing up and the others down, be suspicious. Look at the various technical indicators to see if they agree. Are the chart patterns being confirmed by the volume? Do the moving averages and oscillators confirm the chart analysis? What do the weekly and monthly charts show? While it is seldom that all of these technical factors will point in the same direction, it pays to have as many of them confirm the same analysis as possible. A note to end this course. This course is a basic introduction to technical analysis as it is applied to the financial markets. I have tried to show you briefly the primary tools used by the technical analyst. Your success depends on learning these tools and combining them to analyze the charts and attempt to forecast the markets. Technical analysis provides an excellent vehicle for market forecasting, either with or without fundamental input. It's not necessary to be an expert chartist to benefit from chart analysis. However, chart analysis will go a long way in keeping the trader on the right side of the market, and in helping to pinpoint market entry and exit points, which are so vital to trading success. Whether the participant is a day trader or a long-term investor, it's to his or her advantage to learn about chart analysis.